So last year, LIA, Life Insurance Association of Singapore, announces that the number of insurance policies being purchased online is increasing in the insurance industry. We are very happy to see this increase in the trend of buying insurance online. Why? Because FSM have always been a DIY investment platform. So even complicated instruments like investment products can be on a DIY approach, so why not insurance? Here at FSM, we strongly and always believe that insurance should be kept simple, and if it is simple enough, customer will be able to purchase it online yourself. With this increase, we are happy to see customers like yourself slowly pivoting towards purchasing insurance products online. Gone are the days whereby you have to reach out to agents to sit down for a few hours or even have multiple follow-up appointments with them just to purchase one insurance product. But of course, we are not saying that all this is a waste of time. Because if you are unsure of which product that is suitable for you from the huge spectrum of products available in the market, it is always recommended to have a chat with an agent to do a simple financial analysis together. But we also do understand that there are some customers that do not like the idea of sitting down with an agent for a few hours. This is why we would like to make use of this short session today to walk you through some simple product types and insurance coverage priorities so that you can also single out your own protection gaps on your own and embark on a journey to purchasing insurance online yourself. So first and foremost, even though there are many insurance products available online, but just how confident are you that you are purchasing the correct insurance online yourself, or in some cases even offline with your agent? Buying insurance on an impulse without proper identifying your needs and understanding of the various product types would likely lead to an event called buyer remorse, which is once an individual purchases an insurance only to realize they shouldn't have done so. Just 2 weeks ago, I met a client online. She is holding on to an ILP, investment linked policy, that she purchased 3 years ago. Her intention was to simply achieve a certain savings amount for her youngest child university education. She told me that she regretted the purchase and that the policy value is in red now. She is also having doubts whether the market can recover in time to allow her policy to grow in value to achieve the intended amount. She then added that the advisor she met told her that this product will potentially give her a higher returns compared to a usual endowment plan. Okay, this remark by the advisor is not entirely wrong, but it is very dependent on the market condition. My take is, if the goal is to save for a child education fund, this goal itself already comes with a fixed time frame that we can anticipate. In this case, in another 20 years' time, the child will enter university. No matter what happens, we know that this client will have to provide X amount of money in 20 years' time. So shouldn't client go for a plain vanilla endowment plan that can achieve the intended amount on a guaranteed basis rather than go for an ILP that does not offer certainty 20 years from now? Why take a gamble on something in which you can guarantee to provide for given a fixed time frame? So we arrive at this question. Was the product really something that can achieve the intended goal? Yes, it can be, but it is not guaranteed. How can you avoid buying insurance because of external pressure, misaligned expectations between you and your advisor? If given that you are still purchasing the wrong insurance with your advisor, just how confident can you be in purchasing an insurance online by yourself? They are best suited for some of the more common coverages that every one of us will be looking for in the market at certain stages of our life. For example, if you are looking for hospital insurance, you shouldn't be buying a term or whole life, for example. You should be buying an integrated shield plan, because a hospital plan will reimburse you for medical expenses, but a term or whole life plan will not. Insurance products were designed in the first place to be simple. If you need A coverage, you purchase A insurance. If you need B coverage, you purchase B insurance, so and so forth. But as time passes, insurers innovate to come out with new products to keep up with the consumer buying habit. Many products now offer multiple coverages in just one product alone. This is why consumers like ourselves have to be clear have to at least know what is the base product type so that we will not get too carried away by the numerous add-ons one plan can offer. Now that we understand the basic insurance types, here is a simple insurance needs pyramid to show you which insurance should you prioritize first. Just like building a pyramid, we don't start building it from the very top. Likewise, we don't build our insurance portfolio starting from savings or legacy planning products. So why do many insurance agents use a pyramid to explain the level of importance for each insurance type? It is because the base of a pyramid is always larger so that the whole structure can be stable. And because of its larger appearance, it can be seen as the largest safety net that you can fall back on to cushion your fall. This is also why hospital insurance always forms the base, because hospital bills can at times be large and hefty, and this product will be there to cushion the impact to you. So many of us will already have a hospital plan in place. So what is next? As we refer to the pyramid, we arrive at life insurance, because a hospital plan does not offer you any form of death benefit. It only reimburses you for any medical bills that you incur. But is life insurance necessary? For example, I'm only 30 years old. Is thinking about death a little bit too far-fetched, too exaggerating? The truth is, no one really knows. Whether you are 9 to 5 or self-employed, your income might help to cover a portion or even all of your family daily needs. Expenses doesn't just go away overnight after one's passing. Your family will still need to cover these expenses and carry on with their daily lives. This is when the death benefit from a life insurance policy can help to provide the funds your family may need to help cover for any immediate or future expenses. And the last thing you want to add on to your family is any financial burden in the form of debts to your family, while they are actually already grieving over their loss of you. You can mitigate all this potential stress and burden for your family in an already difficult time. I have always told my own clients to see buying a life insurance as a form of risk transfer, because you pass on all this risk of financial burden to a huge corporation that is more than willing to pay for your family this large sum of money in exchange for a level of premium that you can decide based on your own finances. So now that we single out that maybe you are lacking in death coverage, we can start looking at which product type that can effectively cover this gap at the lowest cost-effective way. There will be term life and whole life insurance. It is actually very easy to differentiate between the two. First difference will be the period of coverage. We can easily remember them as term to be for a fixed term only, like a fixed period. But that being said, there are many insurers nowadays in the market that provide coverage until the age of 100. But a whole life plan will cover you, as for the name suggests, your whole entire life. There is no short-term period for this particular product, so that's one difference. Second difference will be the pricing level and cash value. Do you want to be able to surrender the policy in the future for some money? If no, you can go for a term life because its premiums are usually cheaper compared to whole life plans. Whole life can be expensive in terms of their premiums, but it does allow clients to be able to terminate it for cash in the future. Here you can see a simple comparison when it comes to the premium for both plans. In the table shown, we have selected products from different insurers to provide an unbiased illustration for a sum assured of $500,000. Term could be the better choice for savvy and self-directed investors. The premium difference can be used for other purposes to generate returns of higher savings. For those who wish to have a lifetime coverage, term life insurance up to age 99 can also be selected. Alternatively, there are also term life products with option to convert to a whole life coverage for a lower sum assured when needed at a later stage in your life. That being said, not everyone is a self-directed investor. Whole life plan can be a good alternative to enjoy both insurance coverage while having a little investment element that does not require active monitoring. Whole life plans can even have the potential to provide a return higher than the total premiums paid by you in the longer term. How much coverage do you actually need? Okay, a general rule of thumb is to have 10 to 15 times your annual income. But this is not the only thing that you should take into consideration. You have to take into account things like your existing debts, any need for income replacement, etc. In this example shown, you can see that the coverage needed is only $840,000. If the insured were to purchase a term plan of 3 million sum assured, for example, will that then be overinsured? This question can be subjective, of course. But the point that we would like to put across is that you should at least know what is the estimated amount of liabilities that you are looking to get coverage for. To some, over-insuring might be acceptable if they have the financial muscle to flex for the additional premiums, so long as it is within the insurer's insurable limit. But what if your family have to deal with the financial burden in the event that you are underinsured? This is definitely something we all hope to avoid, and the sole reason why we buy life insurance. So I hope all of you are ready and confident to renew your own portfolio, and for those that have already identified your own protection gaps, get insured with us. Because one thing we can promise our clients is that we aim to keep insurance costs as low as possible through one of our very special programs. I will speak more about this later on. We have many products from some of the biggest insurers in the market on our platform, and I'm very sure that we will have one that can cover your existing protection gaps. Many of you might be familiar with the investment articles that FSM constantly publishes on our website, but do you know that our in-house insurance team also produces insurance articles? We provide regular updates on insurance changes to our clients through our articles. Furthermore, we understand that with the wide selection of products available in the market, clients often have a tough time choosing the best one that fits their insurance needs. So feel free to browse through our articles online, and my team might just be able to enlighten you. I cannot emphasize enough that here at FSM1, we strongly stand by the fact that insurance must be kept as simple as possible. No hidden costs, and as transparent as we can be. And most importantly, keeping insurance costs as low as possible for our clients. So what kind of program do we actually have to help our client in lowering this cost of purchasing insurance? Whenever we talk about insurance, many people will think about the high commission that agents' charges can receive if you buy the product from them. Firstly, do you know that advisors receive commissions from the premiums that you pay for your own policy? And in some cases, agents can be able to receive commissions from your policy up to the first 6 years every single time you pay your premiums. So how is it different from FSM? Allow us to show you a short video before we continue.
At FSM1, we believe that insurance is purchased as a protection against unforeseen circumstances. We pride ourselves in transparency and that insurance should be simple and easy to understand. If you fully understand the product, you can just get covered at the comfort of your home. And whenever you need more advice, our advisors will always be ready to assist you. We constantly aim to pass down as much savings as possible back to you because we believe insurance should always be affordable. And how do we achieve this? Firstly, we have all heard about high commissions for agents when it comes to the sale of insurance policy. Do you know that commission comes from the premiums that you pay for your policy? The premiums you pay are both for your protection cost and commissions. Furthermore, your agent may receive commissions from your policy for up to the first 6 years in most cases when you continue to pay your premiums. However, we believe that purchasing insurance for protection should always be affordable. This is why we share a portion of our commissions as commissions rebates back to you. While some companies are offering commission rebates as well. Do you know that they may deduct their relevant fees or commissions first before sharing a portion to you as commission rebates? But at FSM1, when we receive the commissions from the insurer, you will receive your commission rebates first before we share the remaining with our advisors. This way our clients will be able to receive maximum value back, and it is our way to show our clients that you always come first. Furthermore, most companies only offer commission rebates for only the first year. But with us, you may enjoy commission rebates for up to 6 years. Commission rebates will be credited into your cash account 3 months after policy inception or renewal. As you can see, we offer commission rebates to lower the cost of buying insurance. But we strongly do not encourage buying more insurance if you are already sufficiently covered just to enjoy the commission rebates, which you may end up with duplicated coverages. Insure with us, without any fuss.
Okay, if you don't already know, whenever you purchase an eligible product from us, we will automatically reward you through our commission rebate program. So why are we doing this? We don't align ourselves in keeping all the commission we receive from the insurer whenever you insure with us. This is why we will never focus on just pushing and selling the highest commission product. Or if you are already sufficiently covered, we will not ask you to purchase even more. And most important of all, we believe insurance should be affordable and at no additional cost. So whenever we receive the commission from the insurer, our clients will be the first in line to receive a percentage of it as commission rebates. After which, we will then take whatever that is left and just keep it as our service fee or overhead costs, so that you do not have to pay for anything extra for our services to you. Here is a simple example showing how the program actually works. Here we can see the example Mr. Tan have purchased a term plan with annual premiums of $1,000. The insurer will be giving FSM a commission of 50% of the annual premiums, which works out to be $500. So when we receive this $500, as Mr. Tan is our Ruby customer, he is entitled to the 30% of the commission as commission rebates. We will then be crediting 30% of $500, which is $150 to his cash account. In the end, it works out to be that Mr. Tan will only be paying $850 for his term plan. Hope with this simple illustration, everyone can now understand that with our commission rebate program, we emphasize lowering the cost of insurance for our clients. And with that, I've come to the end of my presentation. If you have any questions, please feel free to look for us at the FSM1 booth. Thank you.